Hi everyone, welcome to this panel and Q&A session on the finance sector's role in driving sustainable development. I'm Tim Penketh, the founder and CEO of TheFutureEconomy.ca, and I'm your host and moderator for today's discussion. Thank you very much for joining us and making it today. I see that some attendees are still joining in, so while they do, I'll share a few guidelines for the session. If you're watching on a computer, which is recommended over mobile, you'll see a join the chat area to the right of the video stream. Please enter your name and your organization and click accept, and then you can participate in the live chat during the session. This is also where you can input your questions for the Q&A session. So go ahead, type your name and organization in, enter the chat, tell us who you are and where you're joining in from. As I just mentioned, there will be a Q&A session following the discussion, so I invite you to write your questions in the chat box throughout the session, and please mention who your question is for if it's for a specific panelist. Today's session is going to last an hour. About 40 minutes of that will be for our panel discussion, and the last 15 minutes for a Q&A from you, and we'll try to answer as many of your questions as possible. We'll be ending with calls to action from each of our panelists, so really stay to the end as much as you can. Before we begin, I'd like to thank our partner for this event, the World Business Council for Sustainable Development, or WBCSD. WBCSD is a global CEO-led community of over 200 of the world's leading sustainable businesses, and they work collectively to accelerate the system transformations needed for a net zero, nature positive, and more equitable future. And I really want to say that it's been an absolute pleasure to work with WBCSD as a partner, and so my sincere thanks go out to them. In terms of what you should do, I think you should check out WBCSD.org and download their Vision 2050 document. It's a really impressive and important framework for action for companies of all sectors that are looking to drive sustainable growth. And also they're looking to grow their reach and presence in Canada. So if their values and vision align with you and your organization, do get in touch or reach out to me or TheFutureEconomy.ca, and we'll be happy to introduce you. So today we're speaking about the future of sustainable finance, which is an absolutely critical conversation to have when we're looking at the sustainability of our future economy. And that's because finance and financial services are at the heart of all sectors of our economy. And so, guided by the WBCSD's target outcomes for the future of sustainable finance, we're going to lead this discussion sort of in a three-chapter way. We're going to be discussing what has to be done for our financial system to recognize the value of social and environmental outcomes alongside financial performance, how we can ensure that the finance sector's capital allocation enables sustainable development, and what must be done for the financial system to have access to the data it needs on corporate sustainability performance. And I just want to mention, so in 2021, there was a lot of talk about corporate net zero emission promises, mandatory climate-related disclosure, and regulatory changes. And what I want us to achieve with this session is to go beyond those talking points and really focus on the actions we need to take now to move forward. And so, as with everything we do at TheFutureEconomy.ca, I'm looking for the panelists to deliver their calls to action, focus on who has to do what now to make Canada's financial sector as sustainable as possible. And I also call on you, the audience, to not let them off easy. Use that chat box and ask those hard questions about what we need to do. So let's get to our panelists. We've got four accomplished and visionary leaders at the intersection of finance and sustainability. First, we have William Sisson, who is the Executive Director for North America of the World Business Council for Sustainable Development. WBCSD member companies come from all business sectors in all major economies. They represent a combined revenue of more than 8.5 trillion US dollars and 19 million employees. Bill directs and oversees WBCSD's regional member relations and their sustainability projects. Next, we have Christine Bergeron, who's the president and CEO of Van City, which is a values-based financial cooperative based in Vancouver and Canada's largest community credit union. The bank, or the union, has over 28 billion in assets under administration, and Christine also chairs the boards of Van City Community Investment Bank, in BC Investment Corporation, and the Women's Enterprise Center. We also have Rob Westling, the president and CEO of Cooperators, which is a leading Canadian financial services cooperative. They offer insurance and investment products, and they have over $56 billion in asset under management. He's also a board member of the International Cooperative and Mutual Insurance Federation, where he sits on the executive committee. And last but not least, we have Som Seif, who's the founder and CEO of Purpose Unlimited. They provide asset management, SME lending and financial tools, and other financial products with $17 billion under the Purpose platform. It's a very innovative company. They were the first in the world to launch Bitcoin and Ether ETFs. And Som is also a co-founder of online investment management firm Wealthsimple, where he currently sits on the board. So thank you all, panelists, for being with us today. It's an honor to have you. And let's just get started. I want to turn to Bill of the WBCSD to describe their Vision 2050 as it applies to financial services specifically, and to present its target outcomes for that sector.
Thank you, Tim. And what an honor to be here today with Christine, Rob, and Som. Truly three great leaders for an effort around how we transform the thinking and the execution of our financial sector. WBCSD has been around for 27 years. We're really stood up as an organization to represent the interests of business as they take that journey towards addressing the real challenges of sustainability in their companies. And our role is really to enable that transformation that we talk about. Our work in Vision and the Vision 2050 that we released last spring was really a refresh of an earlier version we did 10 years ago, and wanted to take a more accurate and current look of how systems are working towards the objectives we need by that 2050 timeframe. And let me start with the vision. A world in which 9 billion people can live well within the boundaries of our planet by mid-century. And that's an aspiring vision, but it's also a fundamentally necessary outcome that we're driving together with our members towards. When it comes to the vision itself, we framed 9 critical sectors, one of them being the financial services and products area of the economy. And we talk about this in the context of 3 global imperatives. The imperative of addressing climate change and taking appropriate climate action, the real attack on nature that has been underway, and the biodiversity loss that we're all experiencing today. So the address of the imperative around natural and nature action. And then on the scene, more resident today than ever before, is addressing the issues of inequality and sort of the social infrastructure and societal issues that all businesses and business leaders need to really get their arms around. For the financial services and product sector, we talk about 4 real goals in that transformation. The first being how the financial system will recognize the value of social and environmental outcomes alongside that of financial performance. We know that's an essential and fundamental way forward. Financial capital allocation. The second, financial capital allocation enables sustainable development. We need it to enable more in these areas that I talk about in the imperatives. That the financial system has access to comprehensive and comparable data. This is really important, and I'm sure some of our folks here today are going to talk about that. And this is really where information about performance, measurement, verification, and in some sense, assurance really becomes resident in the conversation. And last but not least, how the financial system works for everyone. In this context, I refer to this as just capital allocation. Just as we need a just transition, we need capital to flow equally and justly. I know this isn't easy. None of us here are going to talk about how easy this is to do, but it's essential if we're going to get to that fundamental vision. So again, I'm really thankful for the opportunity to be here today and working and communicating and talking with these three sustainability leaders in their own right. I'd love to hear their views going forward. Back to you, Tim.
Well, thanks so much, Bill. Thanks for setting the vision and also the different chapters that we're going to be attacking during the conversation. I want to start with some scene setting for Canada. And this is open to all panelists. So Christine, Rob, Sam, whoever wants to jump on it, please do. So in general, how would you characterize Canada's current performance with regards to sustainable finance? So where are we now? What are the trends and forces shaping this? Who wants to jump on that first? Don't be shy.
Well, I'll kick things off. And first off, Tim, thanks for having us. And it's a real pleasure to be here to chat about this. This is a really important conversation. And, you know, look, this is a long tail event that we have to deal with in terms of planning. But you know, we have to start now, as we all know. And the reality in Canada, I'd say, is that we are, you know, we sort of look disorganized. We're you know, we don't have a clear path in terms of cohesive strategy, taxonomy in Canada, and I think there's a lot of confusion. You know, from both a corporate, regulatory, investor, you know, capital allocator perspective, that I think is unfortunate for a country that ultimately has stated pretty vocally its goals of, you know, being net zero and you know, being a leader globally, not just call it a follower like we've seen south of the border and other parts of the world. And so, you know, I think it's somewhat we're in a very dire situation, I think, in this country to get organized. And you know, and I always look at the EU, and you know, where they've kind of got a little bit more alignment, more synchronization around taxonomy, but they're multiple jurisdiction countries. I mean, we are just provinces, multiple jurisdictions, and we can't get organized. So I think Canada, unfortunately, is not in a well structured place. And I think the oil and gas industry plays a role in that. The fact that our economy is so historically reliant on it has sort of played a political role in our ability to get you know, aligned.
Well, thanks for calling it as you see it, Sam. I knew you would. Christine and Rob, what do you think? Do you agree? Do you disagree? Where are you at on this?
Yeah. Okay, I'll go. It's the tricky part on the virtual world. Yeah, I don't disagree. I think, you know, you said at the beginning too, this view of there's two parts of the question: sustainable finance. So there is climate, but it's broader than that, right? And so certainly when we think about underserved communities, I'm joining from Vancouver, as you said, which, you know, I'm on the lands of the Squamish, Musqueam, and Tsleil-Waututh nations here. And once again, you know, we're discovering new graves here in BC, which is very difficult to be thinking about sustainable finance and not thinking about reconciliation as well. So I think, you know, you think broadly, we often tend to lean to climate, but it's also broader than that. And then I think the second word that you talked about was performance. So not about our interests, not about how much discussion is happening or engagement, but actual true demonstrated performance. So I agree from that perspective, we're nowhere near, you know, where we need to be and probably where we should be.
Yeah, I'll build on my colleagues' comments. I'll agree at least that while there has been progress, there hasn't been enough progress, certainly. And you know, I almost think it's perhaps a bit of a mugs game to for us to compare ourselves to other countries when you know, there's a place that we have to get to, and it doesn't matter if we're ahead or behind necessarily. It matters that we get there, and we're not going to get there at least at the pace that we're going now. So positive movement, but not enough. I'm heartened by the by the number of conversations that are happening, the engagement that's happening across the financial sector in areas like the Sustainable Finance Action Council that Christine and I have the privilege to sit on. But I think there are some really key steps that need to be taken. One is certainly around taxonomy, being able to effectively understand the transition risks that our society is faced with and individual entities are faced with. Also, the physical risks that they're faced with. And I'm actually very concerned that we may leave this piece behind, and it will be really detrimental to our ability to really understand what steps need to be taken in order for us to have an orderly transition to net zero. I'm concerned that we'll end up with a disorderly transition if we aren't keenly focused on understanding and disclosing transition risks and physical risks.
Well, Rob, you said it's not that great to be comparing ourselves to where other countries are, but I do want to get a sense from an outsider's perspective. Bill, you're a member of a global organization. You're based out of the US. When you look at Canada, both in terms of the pronouncements we've made, but also where we are in terms of turning those into concrete action, how do you see us positioning ourselves or comparing ourselves internationally with our peers?
Yeah, that's great. And Sam and Christine and Rob, thank you for sort of being very frank and honest about sort of the ground that you see we're on today. But from my perspective, I clearly see, and I suppose this is a bit of the good news and the better news. Canada, you're emerging as a leader, whether you know it or not. And I think, that's at a sort of a broad brush sort of frame of reference, but let's look at some of the sort of the characteristics that I'm referring to. In contrast to the EU, the UK, Japan, and other countries that you may look to see as more advanced, and frankly, they probably are. But let's go back to Canada. I think first and foremost, you've got leadership at the highest level. You've got your prime minister advocating and asking for mandatory disclosure when it comes to climate. That's an important ingredient, right? This reference framework of the Task Force for Climate-Related Financial Disclosures is resident in many of these other countries, and it's finding a home in what you're planning to do in Canada. So I think that's a first ingredient, is the leadership. The second is already seeing action. So some of your largest pension funds are starting to shift their criteria towards more climate-related investment choices and decisions to build out that sort of future look, that long transaction tail that they see as important for their asset investors to take account of. So you're seeing those shifts that are taking place today. And then last but not least, this is a signal, if anything, but it's a positive signal that coming out of COP26 last year, at the end of last year, the announcement of the International Sustainability Standards Board. This is going to be a governing body that gets at some of these very murky, challenging issues that you're raising, Sam, about disclosure, about getting through the confusion of information and how access to common understanding, that taxonomy element, is going to sort of transact out of the ISSB. The reason I bring them up is they're putting Montreal as a co-host city. That's not for any other reason other than a recognition that there's some very good work and some very good thought leaders resident in Canada to help contribute to that. So those are sort of three signals for me anyway that maybe move us away from sort of a dire situation, at least giving hope that there's a framework around which some of those challenges that you raised are going to get addressed, at least going forward.
And I would just add, I think Bill's point's a really valid one, an important one that, I think, look, from the top, we are speaking the right language. We are talking about this, and it's prioritized as a topic in communication broadly. I think one of the things that I kind of highlighted that, we struggle with is that right now we are a country that has, we are a really big polluter because of our, major industries in oil and gas and commodities. And I think that anything that's going to be successful in Canada, the only way we're going to align is that, I think to Rob's point, we need a really strong transition plan that includes a recognition that we are going to be a part of the oil and gas industry for some time, and it's going to be a part of the solution. And until we ultimately get that alignment, I don't think we're going to get a single, call it voice or a single taxonomy, a single perspective and alignment. And I think we have to recognize that this is who we are in Canada, and we can't shut down the pipes right away, and we got to start moving towards it. But there has to be a plan.
Well, outcome one of the WBCSD's vision for the financial services sector is that the financial system recognizes the value of social and environmental outcomes alongside financial performance. And I think I hear from you that we are speaking that language, we are moving in that direction. But as I said, we want to focus on what it takes to what actions are needed to really move the dial. So how can that cultural or behavioral shift that we are seeing and this focus on ESG factors be accelerated and turned into real change, true sustainability, who has to take the lead? Is it companies? Is it regulators? Is it the clients themselves? Where do you see the impetus for real action coming from? Or where should it come from, excuse me? I'll turn to Rob for this one.
Yeah, Tim, maybe I'll start off. So your question is a how question. I'd like to start off with the why, and I hope that it feeds well into the how. I'll share a little bit of our experience at the cooperators, and I'm thinking specifically of our impact investment portfolio, our ESG portfolio. So fully 20% of our invested assets, about $2.5 billion, are in externally verifiable impact investments. We've been at this for about a decade now. And our initial goal was 10%, and we didn't think we could get there. It's 20 now. It will continue to grow. 100% of our invested assets go through an ESG lens. It's not a screen. It's integrated across the other factors that we look at. And our experience is that impact investment portfolio performs as well or better from a return perspective as the benchmarks that we compare it against, and it's been way less volatile. And so, this is not philanthropy, is the point here. And I wonder why it would be. I mean, there's a better risk profile for businesses that actively consider systemic risks across time horizons. Right? I don't want to own a company whose management team is focused on the next 3 months. I want to own a company whose management team is focused on the next 30 years. In addition to that, when I think about the expectations of our members and our clients, our stakeholders across our various businesses, those are increasing significantly in this space as well. And so before we get to the how, or before I get to the how, the why is really important. It's fundamentally good business. And I think that is, that's been such a catalyst for us. I think it could be such a catalyst for the entire financial services sector if we came to that conclusion. And then in terms of the how, it's been really critical for us to define the opportunity for our stakeholders, to share things like what I've just shared with all of you now, to set targets that are achievable, but then to set really bold aspirations. And so I've mentioned we've hit our targets in terms of the impact investing throughout, but as a leadership team, from the very beginning, we've been asking the question out loud: why 10%? Like, why wouldn't 100% of our invested assets be driving positive externalities in some way, shape, or form? And to that end, we've got a new set of targets for 2030. And so by 2030, our target is that 60% of our invested assets will either be in impact, transition finance, or a new category that's called resiliency finance, which is really about protecting our communities from the impacts of climate change. So it's an adaptation approach alongside the mitigation approaches that we've been taking.
And Christine and Sam, in terms of the how, what do you see pushing your organizations forward towards these outcomes?
And maybe I'll add on. So I first fully agree with Rob's perspective. And, I think part of it is the key, it sounds easy to say, it's very difficult to do, to make that deliberate strategic decision. So in our case, as a financial institution, for others, whatever they are, to define return in monetary and impact terms. And so to define the return of a loan, credit, investment, it's how do you get the definition of that, the impact on people and the impact on the planet. So with climate, it's becoming easier perhaps to translate the value, but certainly the impact on people is hard. But once you actually adopt that kind of mindset, it's much, then you have to just think through, you sit down and figure out how to embed that into your decision making, right? And so I think what's interesting is when you think of ESG considerations broadly, yes, if I've read many surveys and research reports, I'm sure all of you have too, it will say that ESG considerations are at the top of all CEOs' priority lists. But then when you look at decision making and then they answer, how are you making decisions, or how are executive teams making decisions, it's only financial consideration. So if you aren't actually pulling those together, you're not going to change the outcomes. And I can give you an example of how this happened at Vancity. Because we're a triple bottom line organization, we created guidelines for making lending and investment decisions, built that mindset into decision making. So when we evaluate something, whether it's a business or a project or a stock, even to our funds, it's about what, besides financial, it has to make financial sense. But financial sense is also different than maximizing the profit on each investment. And so we look at what will the impact be on people and planet. If we make this loan, will it, help people's well-being? Will it increase harm? Will it be neutral? Will it increase emissions or not? And we have definitions that the team can use to really think through that. And it's become quite formalized. We report on it, we're audited on it. And so we do think differently in terms of how we make decisions. So I think that's, that gets into the longer term perspective and so much of what Rob was talking about on how do you really change the mindset to make decisions that are actually truly integrating those ESG considerations.
So first off, I think we have, I'd say Cooperators and Vancity are two great organizations and have, kind of highlighted when an organization gets behind us, what can be done and on behalf of all the stakeholders. I have a little bit more of a cynical perspective of this, which is that, as a math person, I come from the perspective that the only thing that matters, the only thing that talks to these corporations is going to be capital. And frankly, I think it's naive to believe that en masse corporations are going to move away from a single stakeholder model. I mean, it was hard enough to get them to start to move away from a shareholder mindset to start thinking about a couple more stakeholders. That's been maybe the last 10 years or 15 years post-financial crisis, a little bit more accelerated. But to move to truly integrating ESG, sustainability into their corporate behaviors and thinking more broadly beyond just profits and financial metrics, the only way is going to be capital. And this was my thesis from the beginning. When I started Purpose, I always said, we need to change the way capital is allocated. And so, we can talk about all these things but board members, CEOs will listen to, the capital formation and whether they get a cheap cost of capital or an expensive cost of capital for their activities. And, look at the auto industry. I mean, the auto industry could care less about EVs for a long time until Tesla started to see a significantly cheaper cost of capital. And, that cost of capital became a massive advantage for them. And now everyone is focused on it. I mean, that's what it took. And unfortunately, it's sad, but that is what it is. And so I've always believed that, the best way to do this is focus on the capital allocators, the way capital is formed, and ensure that they are focused on it. Now, there's a whole bunch of things that have to happen to allow them to be successful. So all the things around, of course, governmental, regulatory disclosures, things like all these things, consistency of data, all these things matter so that we can actually analyze and do these things properly. But at the end of the day, if capital doesn't start to change its mindset towards this, that ESG principles are critical to the way they allocate capital. And it's not just, as I think, Rob, you said, charity. it is in value-added investment policy and decisioning, then I think that ultimately it doesn't matter. And I'm very happy to see in the last couple of years, money managers like BlackRock and others starting to speak about it, being more, purposeful in their messaging and the product development. But at the end of the day, today, still, the majority of capital is still allocated to traditional investment policies that have no ESG screening. And I think that's where we have to focus. And now, of course, the Canadian pension plans have been great at starting to implement it. But, I think there's still governance mandates that have to change at these allocators' perspectives to be able to do it effectively. So,
well, Tom, if I can just jump in for a moment. So it likely sounds like we're having a vehement disagreement. I actually think we're having a vehement agreement. The reason that I was highlighting that these activities have been good business for the cooperators, and will be even more so in the future, is exactly for that reason. Every organization isn't going to follow the path that a Vancity or the cooperators has followed. It's built into the DNA of the cooperative nature of our organizations. And that's why it is so important that we get the risks disclosed so that the capital can flow to the right places. Right now there's this big blind spot that is having capital allocated into places that are absolutely going to be that absolutely have stranded assets, into places that absolutely have an unreasonable level of risk for the amount of rate of return that they provide. Challenge is we just don't know it. And I'm actually very confident that once we do, that capital allocation will start to shift in the right direction.
And I agree with you, Rob. I mean, I think you're bang on. As I was saying, there will always be companies like yourselves that are, it's in their DNA, it's in their, call it foundational principles, and it's awesome. And you'll see more and more companies do this. But if you look at a probability curve, we're just not even close to tipping yet. And I think the only thing that's going to tip it truly is large formations of capital showing people that that's the right way to do it. And boards aren't mandating it to their CEOs, and the CEOs aren't pushing it to their boards. And ultimately, therefore, they're all focused on financial metrics.
If I could interject, I spent 30 years of my career in the private sector, and the last 15 or so of that career was really trying to stand up the sustainability interests of the company, which was, by the way, led by our CEO at the time. The reason I bring this up is because the financial market conversation wasn't happening when I was doing that. That was 15 or 20 years ago. But I always thought to myself that the day the CFO starts to ask me questions about why I need to be thinking differently about ESG, we didn't call it that then, but it is what we're calling it today, I knew that things would start to move quickly. And I think, Sam, to your point, and Rob, to your point, we are at that inflection point where there is a recognition, and I see this amongst our members more and increasingly, there's a recognition at the CEO level that the market characteristics of capital flow are changing, and that it's important for information that we talk about, that being the ESG proxy for how well my company is managed, how well it's prepared, how well it's risk assessed, and frankly, how well we're going to be around in another 50 years is becoming increasingly important to how capital markets are putting their money into those investments. So I think we're at that inflection point, and I believe wholeheartedly, because I have to, that you're right, Sam, you are absolutely right. The capital market transaction framework is changing, and you're a big part of that. And let's talk about BlackRock for a second. Larry Fink has put out now his 5th letter. Some of you may have seen it, but one of my preparers actually wrote this down for me, and it's quite relevant. He writes, access to capital is not a right. It is a privilege. And the duty to attract that capital in a responsible and sustainable way lies with the CEOs. And I think that's the transformation that we're going through. So, Rob, I have hope, and Sam, I have tremendous hope that inflection point that I'm kind of seeing is starting to take hold. And I'd love to hear your views on if you agree or disagree with that.
I absolutely agree. Like, I mean, look, relative to even 3 years ago, you've seen a massive shift. And now we've been in a very good backdrop of capital, value creation and all the rest of it. So, really gets tested when, returns and stuff get more challenging. We go into recession, where do people focus? And I think this goes back to, I think, Christine, your comment. If you have, as a corporation, a triple P type of perspective of the way you think about, your mandate and your, what you're measuring, then that becomes foundational. But if you're just doing it because, hey, I have some excess profits and I can do these types of things, then that's wrong. And so, I think there's a lot of work still left to do, and we haven't really tested it through a market cycle. But I'm very encouraged by some of the things that you're seeing, coming from Canada. One of the great things that was brought up earlier is that some of our largest asset owners, the pension plans, have started to take this more seriously, and that's wonderful. So I think that, if we can see this more and more in the way that they influence their capital into the market, not only to companies, but also to asset allocators themselves, then, I think that can, really spread in a more meaningful way. And I think, BlackRock as an organization has a big foot. I mean, they have a big footing and they have a big voice. And so, the more Larry talks about this stuff, it's really critical. And, my ambition always was, if I can do this, when we implemented ESG as a core screening across all of what we did, I said, we're not an ethical investment firm. What we are is we're looking at it as an investment opportunity for our investors. But most importantly is I want to prove, and this is back in 2018, 2017, when it wasn't du jour yet, I said, I want to prove to people that an organization can not just do this as a set of products off the side of their desk, but rather as the core to what they represent. And so that everything we do is oriented towards this way. So I would love, and I said, my ambition would be that one day BlackRock stops saying that, hey, we're going to launch an ESG fund, but rather says every one of our $10 trillion of assets that goes through our entire complex has an ESG component to it. That would be progress.
Yeah.
Well, case in point, when we were thinking about the title for this event, we were trying to find a way to not use sustainable finance, because it should just be finance, and that's really where we want to get to today. Christine, I want to come back to you, just because in the pre-chat you told me that you were quite interested in this idea of how do we best allocate capital to ensure sustainable development. And one of the recommendations that the WBCSD has is that the cost of capital decreases for sustainable business activities while increasing for those that are unsustainable. And a lot of what we hear is that you need data, you need a common taxonomy to be able to assess that. So I want to hear from you what you need from companies to invest in them with confidence in their sustainability. Are you satisfied with what's out there today in Canada? And what has to be done to move that forward?
Sure, that's a lot. That's about 4 questions in one, but I'll start. I think just the question in terms of the cost of capital, we've been talking about it. So I do think that some of that has begun, but as other panelists have talked about, we're not there yet, right? So you can do a certain amount of that without all the details, but you're never going to get to the true cost of capital if you don't have the risks exposed and the taxonomy in place, et cetera. So we are starting to see some of that, certainly just with respect to stranded assets and the like, but it's not where it needs to be. And then, I think that question of is it feasible for cost of capital to then play out that way? I mean, certainly, right? Again, we're starting to see that, but it's not clear enough. It's not solid enough. And so to the question of what do we need to see? I mean, certainly we want transparency. Transparency is key, especially about the challenges a company is facing, right? Although we work a certain way, first of all, we still have challenges. And second of all, we totally understand that businesses, work within a sector and work within their own frameworks. And it's not easy for them to maybe improve on their environmental footprint or think about some of the social issues. We look at a lot of smaller businesses, so that can be a different construct from say some large public companies, but there are a lot of small businesses, right? And of course, small business owners, especially over the last year and a half, they're just trying to keep their heads afloat. So we appreciate the challenges that they have. So strong governance, though, on oversight of sustainability is important. On climate, it's important to understand how a company is preparing, Rob said it earlier on, physical and transition risks. So, we would much rather see companies that are trying to work towards appropriate metrics and being open about their challenges than simply saying, we can't do it because we don't have anything. So, try until we can get all these other pieces in place that would allow the data to be more comparable. It definitely helps us understand what they're working on. And then I think it's important to combine, and certainly in the teams that work at Vancity on the investment side, to combine the quantitative disclosures with the commentary, so with the qualitative, right? Because it is about the metrics, but it's also like, what is their decision-making process? And as others have said, you go through cycles, and that's when, when the going gets tough, what do you decide and how do you make those decisions? Of course, we would like to see executive comp tied to appropriate ESG metrics, third-party verification of the data, more comprehensive disclosure that's in line with best practices. So whether that's SASB or GRI, or sorry for the acronyms, but ultimately bringing in, the reporting in line with TCFD, more of that has been happening, of course, and just really trying to understand how they're thinking, how they're preparing for the risks. Because they are there, and Rob and Sam have both spoken to that. So those are all the things that we need to see as well as we think about investing or lending or supporting anything from small business all the way through, through our investment arm, looking at public companies.
Rob, do you agree? Is there anything else that you would like to see in terms of allowing you to make your best decisions?
I think from Christine's done a really good job of laying it out. That perhaps the only thing that I would add is that with our institutional investments, we're looking for a really clear path to net zero. So, a commitment to net zero, a plan, interim targets, in addition to that, an understanding of physical risks and a plan to be able to manage those as well.
Sam, what's your perspective on this? Because it has been a topic that's come up a lot.
Yeah, I mean, look, I think there's everything that's been said has been great. I just add maybe to it. I think we need a lot more education. There's a fair amount of call it historical perspective around sustainable, like SRI, sustainable investing, and it seems like this thing that drags. I mean, even the word taxonomy is kind of the bad word, right? It drags on things, and I think this notion that we need to kind of talk about it as actually being a net contributor, a positive, which I think you guys have talked very heavily about. As organizations are stronger and better, right? We need real strong examples. Education, investors need to see it, and investors, and large investors, corporations and boards need to see it. Like they need to see why them focusing on this is going to actually be valuable beyond just capital, but because capital, of course, is going to do it. But I think it's important that they understand it and believe it. The other thing I always just find so amazing is that we don't have sell side research. Like in my opinion, like why isn't RBC or BMO or every single time they put out a research report, why aren't their analysts trained on this information and publishing data on it? Like it just doesn't make sense. Like we're talking about companies every day. Their job is to focus on them. Why aren't they focusing on it too? If the banks, you want to make a big move from a capital markets perspective, I think that would be a really positive thing, is to see real sell side research integrated with this type of thinking and this metrics. Because again, companies will start to focus on it if they're being measured on it too.
And Bill, from your perspective, you cover North America, WBCSD is global. How do you see your members dealing with this issue?
Yeah, I mean, I commonly refer to the data conversation as a bit like we call here in the US the wild, wild west. It's transitioning from an information free-for-all to something that's got to be more consistent, measurable, verifiable, qualified, if you will, so that the financial institutions, the capital markets can consistently sort of measure, verify, and assure that the investments they're making are effective for their own merits and needs in driving this transition. So I think the good news is there is a lot of data out there. And it's resident today largely in, I guess, what I would call the climate space of information. There's an emerging space of data that will start to transact on nature and natural systems with the emergence of the Task Force for Nature-related financial disclosures and some of the efforts being put forward around how we better inform on the nature systems. I'd say arriving on the scene is the whole S context in ESG. Still a bit of a lot, and still a bit of a lot. How's that for a phrase? Still a bit more work to do to really frame what are the proper metrics and measures to build around sort of inequality, human rights, and how to better inform and transact on that. But there's data, the good news. And I think, you know, sort of the developing story is around how data transacts to information that's consistent, verifiable, measurable for the capital markets to react to. I can say, you know, through a WBCSD lens, we have a lot of companies who are trying to drive transformation, this transformation agenda, whether you know, it's the climate, nature, or equity conversation. It's all in for WBCSD members through the conditions and the criteria we require of them as an organization. You know, and sort of having said that, there are some very specific verticals that are starting to emerge in our work. Food and sort of the nature systems associated with the food system are really front and center right now in thinking about how capital markets are engaging with that food transformation. And a bit to Christine's point, this is a supply chain problem. This is small farmers needing to understand their role in access to capital as much as the big food system converters, if you will. And so, you know, this goes back to that point I made right at the beginning. You know, this is a conversation that gets down to the heart of what's just in capital allocation, and how are we making sure that we're addressing these issues, not just for the big, large companies, but that those transactions are in fact making their way all the way down and up the supply chain to in fact some of the organizations that need it most. So a lot going on in that comment, but for sure, I'd love to hear some reaction to that.
Bill called you out. Any reactions to it? Does anybody want to bounce off that? Well, look, we're 12 minutes away from the end of the broadcast. So I want to get to my favorite part, which is your calls to action. And what we're looking here is 30 seconds or less. I'm going to go through each one of you. And in 30 seconds or less, so what is the number one action Canadian stakeholders, and this could be anybody within the finance industry, government, regulators, investors, customers, so on. What does that body, that person, that organization have to do now to ensure or enable our financial services sector to fully support sustainable development? And I'll start with ladies first, Christine, if you don't mind.
I know we still did that, but yeah. Well, you know, I admit I'm never a fan of, you know, the one thing that one group has to do, because I just think it's so broader than that. But, you know, I think one action for companies, and I'll talk about financial institutions, is really, it's what we've all been talking about. It's really shifting to say it's good business and start thinking about business success more broadly, and not in, you know, the way, you know, Sam, as you had said, not thinking about it as like some dream or something that's ideal, but actually concretely saying this is good business, these are the risks, this is what we need to be thinking about, and changing how they make decisions. So linking it to compensation, having the boards and CEOs drive that. So that's more than one action to some extent, but really thinking about profit beyond, just the dollars. Otherwise, from a long-term perspective, you won't be in business in 50 years. So the impact on planet and people as part of how business success is defined. And I'm not naive to what that looks like over time with shareholders and the like, but we're seeing that if you think long enough, that is actually going to be business success.
Great. Sam, who do you want to call out?
Yeah, I mean, look, I think, as I say, capital is a really important component and call them out all the time. But I'd say if we want to really get this thing rolling, you need government, and I would love to see regulators in some form, really focus on companies being forced to report TCFD kind of details. I mean, this simple thing, having a consistent set of reporting that would be published by every company would immediately put it on the radar of what gets measured. And it's true that what doesn't get measured doesn't get kind of managed. And the reality is, if it's measured, it's consistently put out there, and the only way it's going to be done is not companies. It's going to come from regulators. And so love to see that. And if that happens, I think capital will start to flow more specifically. It'll be focused on it. I think you'll see companies focus more and more on it, and I think it'll change things more rapidly.
Awesome. Rob, you're up.
So I get the benefit of going third, and so now I'm on my third different call to action. I agree with both of my colleagues. I'm going to focus on investors then, and my call to action for investors would be that as investors, we need to recognize that we don't have all the data that we need to make good decisions, and we need to demand that data. And so perhaps this is the flip side of Sam's intervention. We need to demand the information, use it in our investment decisions, and be transparent about how we do that, so that companies know that if you don't have a path to net zero, if you don't have a good understanding of your physical risks, that you are not going to get capital deployed from us. So that's my call to action.
Thank you. And Bill, last but not least, please.
Can I just say what they said? No, absolutely. It's fundamental being an organization that represents some of the leading companies around the world. And by the way, 2 of our members are in fact in Canada, but I think it should be closer to 15, to be honest with you, if not 20. But there's a recognition in this conversation that your future is dependent on capital. Your capital is going to be increasingly measured by how well you're performing in the ESG space of the world, if you will. And so there's a recognition that business leaders need to really embrace the essence of this conversation and understand how to come together, whether it's through organizations like ours or through organizations that are resident in Canada, or through the structures that I understand the regulatory and policymakers want to stand up around creating voices and places for voices to be heard, to collaborate, to get at these problems together. Our organization is part of helping to do that, but we need more Canadian companies, frankly, involved in this discussion and helping to drive that transition and transformative change that we're talking about.
Perfect. Thank you. Well, it's interesting, your calls to action touch on a few of the questions that have been asked, and I want to get to those now so that we close out the hour with those. The first is from Guillaume Dubreuil of Canada Steamship Lines, and he writes that it often feels like business is moving faster towards sustainability than governments, and that regulation continues to stand in the way of progress. Are you experiencing this issue, and how can we push different levels of government to move faster? Who wants to tackle the government?
Well, I'll start. I mean, I'd love to hear from a Canadian perspective, but I certainly tend to agree that, I think the rate of change of ESG, if you want to call it that, and I know, Sam, you said you're a mathematician, so maybe you'll react to this. The rate of change of ESG has been dramatically fast, and I think business has caught on in a sense faster than the regulators. But I do think the regulators have a role to play now to work with business. And by the way, it's a good sign that business is actually ahead of the regulators as opposed to the other way around, because we're all at the table waiting for help. And having said that, the regulators themselves need to really amp up, amplify, accelerate now this this challenge around information, consistency, verifiable assurance, so that all companies are playing on a level playing field. And I think that's now it's time for the regulators to step in and help sort of drive that foundation of how do we get to consistency, more simplification, if you will, and then finally a framework that all participants in this financial system can operate around.
Yeah, I agree. And I think that, look, government's role is to create clarity on the road to sustainability. They need to create what it means, so that, of course, capital understands it, so that, corporations and companies and boards, everyone understands what, it means to be successful in this. That we don't see greenwashing, like all these little things, and that's what the government's role is. And I said at the outset, I think there's still a lot of, call it, fragmentation in voice, and there isn't a cohesive and single voice on this, and so companies get confused, and if they get confused, and they then therefore turn their attention to other priorities, unless they have a very strong will. And as we've talked about earlier, I don't think the companies do have a strong will yet. I think there are absolutely great companies that are doing this and have a strong foundational DNA towards it, but not every company has the strong will yet. And so governments get them there. I think about things like cybersecurity. Most people didn't pay attention to it until it actually became real for them. And so the reality is that until something becomes real, then it becomes a part of your psyche. And then when it becomes a part of your psyche, it changes the organization. I think, with government support, we can help companies change their psyche around this.
Yeah, I would just agree from that perspective that the question sort of said business is ahead of government. I think some businesses might be, but not all, and agree, it's a bit of a pull and push situation.
The area that I'd really like to see governments move quickly, and this is a bit of inside baseball because we're in part an insurance organization, is really in the whole field of adaptation. We are building infrastructure. We are building buildings right now that are going to last for 100 years. The environment that we will be operating in that time frame will be far, far different than it is now. And we need to start changing the way that we're building things and protecting things right now. In fact, we needed to do that 50 years ago. So that's an element that's really worrisome for me, where I think the governments in Canada are behind.
If I could just add one interjecting thought too here, which is we talk about timescales here that seem like it's a long way away. And some business leaders frankly think, oh, this isn't my problem. It's going to be the next, or maybe even the CEO's problem 10, 20 years from now. That's not the case. The inflection points we're at today that I talk about need to transact so that 8 years from now, by 2030, things are starting to shift in the right direction. Those are the timescales we're talking about. That's one CEO cycle. So let's not think about this as something for another generation's challenge. This is resident here and now, and companies just need to start getting their arms around it and start to take the actions necessary forward. Get started.
Well, I think that's a great word to end on. Unfortunately, we just have 2 minutes left, and I want to be mindful of everybody's time. We had some great questions that went unanswered. Maybe we can send a follow-up for those. But Bill, Christine, Rob, Sam, I really want to thank you for being here and sharing your insights, and especially your calls to action, and for a great conversation. To the audience, if you enjoyed the panel, please sign up to the newsletter, because the recording will be sent out. You can rewatch it and share it with your friends. And just before we go, I really want to say a big thank you again to WBCSD, the World Business Council for Sustainable Development, for making this possible. They're really a great organization to work with. And I encourage you to go to their site, wbcsd.org, download the Vision 2050 document. It's really an interesting framework for what all companies have to do to drive sustainable growth. And that's it for today. I want to say thank you to everyone. Thank you to all you who joined in, and hope to see you again soon.
Thank you, guys.
Thank you. Thanks.
Have a great
Christine,
day.
Rob, and Tom. Thanks, Tim.
Bye, guys.